Shopify has been downgraded by Loop Capital Markets, but the analyst says it is one of the most compelling long-term fundamental stories out there. We are joined from Chicago by Anthony Chukumba, Managing Director in the Equity Division at Loop Capital Markets. Anthony, thanks for giving us the time.
Thanks for having me.
Your main reason for cutting Shopify is just valuation?
That's right. So the stock has been pretty strong year to date. It's up 21%. It was up 21%. So that's about 1,200 basis points ahead of the NASDAQ. It was trading just below the 52-week high, and it was trading about 7% above our prior price target. So we just kind of felt like upside potential and downside risk were fairly balanced, and we just thought it made sense to go to the sidelines, at least for the time being. This is an incredibly volatile stock, and I wouldn't be surprised if we have another opportunity to upgrade it in the future.
So we're looking there, the price in U.S. trading just north of $120, and your price target is $120, I think. You're leaving that unchanged?
That's correct. No change to the price target.
Now, you may, sorry, Anthony, if I missed this, you reckon the stock is trading at almost 15 times revenue for 2025. Is this out of line for a company of this type?
So that's a very good question. And the comp group, we think the right comp group, it's other large SaaS companies that are great, that are growing their revenues at 20+%. Now, when you look at those names, and you have to kind of throw out Palantir because their valuation is insane, but when you look at those names on average, they are trading a little bit higher than Shopify is right now. But I would say that those companies don't have the tariff risk that Shopify has. And what I mean by the tariff risk is, you know, we are a couple months out now from Liberation Day here in the U.S. when the Trump administration put all these tariffs on. Now, the taco trade is real, like he's chickened out time and time again, but tariffs still are higher than they have been in quite some time, and they may go higher still. And so that is an overhang that, from our perspective, puts a limiting factor a bit on Shopify's valuation.
I had heard, I can't remember who said this, that Shopify might get a boost from tariffs in the sense that there's so much more bureaucracy involved, and Shopify's a big player and they have systems to help companies deal with that.
I think there's probably some truth to that. I mean, look, Shopify's whole ethos is to make things as simple and easy as possible for the merchants, right? To provide all this value to the merchants. And so I'm sure that they have been working tirelessly since Liberation Day in terms of developing tools, like you said, to make things easier, because it's got to be really, really confusing, particularly for merchants who are either importing a lot of their goods from other countries and or are selling internationally. So I'm sure that Shopify's tools make that easier. So that is it's a fair counterpoint.
But you do say Shopify has a bright future, and it has emerged as the dominant retail operating system online.
There's no question about that. And what's really sort of interesting is, if you're talking about just like a small merchant, Shopify, no brainer. But increasingly, Shopify is making a lot of inroads with enterprise merchants, right? With what they call Shopify Plus. And in a lot of cases, it's because it is just a much simpler system to implement. They have those commerce components now where you don't have to do a full rip and replace. You can just kind of replace certain components of your e-commerce, business if you're happy with it. And they're making some inroads even in terms of what they refer to as offline commerce. So, retail point of sale systems. So, I mean, regardless of what type of merchant you are, regardless of the size, regardless of whether you're just purely online, purely brick and mortar or both, Shopify has tools to make your job and your life easier.
So I'm looking here, your estimate for operating EPS, $1.26 last year. You see it going to almost $1.50 this year. You're a bit ahead of consensus, and then almost $1.90 next year. So you do see plenty of growth and profit.
Absolutely. And to be clear, I mean, I think that Shopify trades much more on revenue than it does on profits. I mean, if you look at the P multiple for Shopify, it's insane. I mean, with these SaaS companies, I think looking at, market cap to revenue is or enterprise value to revenue is probably a better metric.
Could they be taken over? I mean, I guess the competition authorities might have something to say about it, but presumably Amazon has thought about it.
I would assume that Amazon has probably considered it at some point in the past. I mean, like you said, I mean, I think that it would be tough from an antitrust perspective. And then also remember, Toby Luckey still has a lot of control, and so I can't imagine anyone buying these guys without Toby being on board. And it seems to me, as far as I can tell, he really likes running his own company.
That's interesting, and he does and he likes to make his views known. And as part of a bigger organisation, that might be tougher. It is incredible, isn't it? The big. Leave us with a final thought, Anthony. As bigger companies migrate to the Shopify platform, I'm sorry we're tight for time. Will that enlarge the valuation?
It certainly will, because look, at the end of the day, if you can sign up one large enterprise merchant, I mean that's the equivalent of hundreds, could be thousands of these small SMBs, and they tend to be stickier, particularly if you the more integrated you are with them. So yeah, if we see Shopify plus the enterprise business continue to grow, I think that would argue for a higher valuation.